This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to the Hedged Edge by RCM Ag Services, where we're getting out of the field and onto the mic to bring you weekly market updates, commentary from commodity experts, and monthly interviews with the biggest names in agribusiness. Welcome back to the Hedged Edge. I'm your host, Jeff Eizenberg, and I'm here with my co-host, Ben Hetzel. Ben, we're back for episode 5. The radio's been good to us. Can't thank KBJM enough and KNDC for having us. I've been new to the radio, but you're an old golden throat.
You had to throw that in there. No,
Sure
it's
did,
good
buddy.
to be on. It's good to be on again. Yeah, I spent a little time on the radio and doing broadcasts of sports events and stuff that happen around the area. So it's always fun to talk to the airwaves, and this is kind of special because it's recorded and we can actually put the image out there so people can see, almost like watching the news anchors on TV. So
That's right. And boy, did we look good. So the quick update here for today's episode for listeners, we're going to be jumping into an interesting situation that we've observed in corn and soybeans. Really, the reality that prices this year are exactly the same as last, believe it or not. And even though we've got a higher supply, in record crops, it's still an interesting phenomenon. We're going to dive in a little bit more into what's been going on in storage, how basis is looking, and then later on we're going to be joined by Jon Berglund from Prairie Land AG, where we're going to deal with a discussion around high input prices, tariffs, and the opportunities coming in fertilizer for 2026. So Ben, with that, let's hop right in. We've talked on how harvest is progressing. It seems to be quite strong. What are you seeing out there in terms of grain coming to town and our storage capacity? Are we filling up?
well, out in our area, it's still a little early. Some of the frozen corn and the more dry, arid areas are starting to harvest a little bit. So we haven't really seen harvest kick up too rapidly. The soybeans are definitely off out here for the most part. The interesting thing to note about soybeans, I heard a little tidbit the other day that the beans aren't coming to town as fast as they anticipated. So you're seeing a little basis shift, maybe trying to entice some beans to still come into the facilities to get shipped out. I think the industry did a nice job of reacting to China not coming in and buying. And so we found some homes, and the idea was that the farmer had nowhere to go with this stuff, so they were just going to blast it into the pipe and probably put some serious strain on the system. But in maybe there's areas that did happen, but there's other areas that it seems like they're needing some beans to still flow into the facilities to ship out for export, or maybe a processing plant that didn't fill up as fast as they anticipated. So that still remains to be seen how it finishes, but notably the basis is doing what it needs to do there, and it should reward the farmers that stored this crop of soybeans to some degree. You can see the carries built in, not probably as much on the crushers as maybe you see in the facilities that have sales on export wise. So a lot to kind of hold and wait and see what goes on there. But I still encourage producers, take advantage of carries, look into the future when the slots make sense for you logistically to move these products, whether it's wheat, soybeans, corn, whatever it is. You know, the space, if you have it on the farm and you put it in there, that doesn't mean it has to stay there. If there's an opportunity that a facility near you wants grain and they're showing it in their basis, it's always good to reward basis
Glad you brought up that basis and the narrowing a bit, particularly in beans. I was talking with the team out in Minnesota earlier this week, and then also got feedback from more the Midwest that seen quite a bit of narrowing on the river. Maybe there's a river trade going on where there's a more flow heading down south to New Orleans. Bases seem to be firm in the cities. Um, Compared to even the processing plants. It'll be interesting to see how that all shakes out.
The other thing that I don't know what you guys are hearing out further east, but you're quite a ways on the other side of this. We're almost both on the fringes, if you think about it. You're kind of still in the heart of major corn and bean country, but you don't have to go far east of you, I don't think, and you get out of it, right?
Oh yeah, you get over to Pittsburgh, the Ohio Pennsylvania border, and it's out there. The grain is out there all the way to actually Delaware. If you never made that drive, I was in Delaware State earlier this summer and couldn't believe the amount of agriculture that is right there. So it's all the way out, but it definitely gets more congested and less the heart of it all.
Yeah. So anyway, depending on where you're at in the geographies it grows soybeans, one thing worth noting that I heard as well is the the production isn't quite what they thought it was in a lot of areas.
Oh yeah, yeah, that's right. And every day now we're wondering what the government's going to put out because we don't have any reports with it being shut down. But we're getting private estimates that are, let's call it ratcheting down the expectations. And it seems to be nationwide, but also we're having to rely on localization of these reports and information flow. And it actually kind of begs the question, if you think about it, do we even need the government reports if we get efficient at reporting from private estimators? But we'll see. Let's
Yeah, it's
leave that one
been an
for AI.
argument.
Maybe AI will be able to tackle that one for us.
Oh, I'm sure. I'm sure it will be. I mean, it's crazy what you can get out of that. It wouldn't be long, and Grok or somebody like that. I think that's the one that kind of goes off of Twitter, formerly Twitter, now X,
Yeah.
for some of its intel. So it could be really interesting.
If you want to listen back to this episode or find past episodes of The Hedged Edge, visit kbjm.com or kndcradio.com under Listen Live and podcast options, or either station's free mobile app under podcasts.
So speaking of prices, let's talk about this historical piece I pulled up. It's a bit of deja vu. If I want to just talk on corn for a second, corn prices today are in the range for 25. I'm going to call this a range being the harvest range, September 1st through today, being more or less a 414 low to a 431 high. That's this year's harvest range for corn. We put that as a pin in that, and then we go back 1 year. 2024, same period. We had a low 386 to a high up there in the range of 430. And then one more year back to 2023. I think harvest tipped off at 505, but quickly got back down to 449. So where we sit today versus the past 3 years, we're really only talking maybe a 10 or 15 cent difference in the last 3 years at this time of year. And what I want to talk about is that we have to be aware of the fact that that's maybe the new norm and the reality that we face. We're going to have Jon to tell us about fertilizer prices and how all of that impacts our price. But people continue to hang on to the idea that they need or have to have $5 corn in order to make money. Well, we've talked about it on this podcast a number of times. Let's assume that we can't get $5. What do we do with these ranges? What do we do in relation to how do we take advantage of basis and other opportunities to price this? And again, wanted to put this data out there for people to think about.
Yeah, that's a very good, not only discussion, but fact that, you know, we're presented with a whole different set of circumstances this year in this crop than we were in those, to some degree. Obviously, with the tariff war and big production. Whether that ratchets down on corn, that remains to be seen. I think we'll see that tighten up some. But the big thing to keep in mind is because there wasn't a bean program, we have had a bigger push for exports, particularly off the PNW, but I would say in general exports out of the US on wheat and corn. So you're probably seeing a wider basis at times here at harvest than what we've seen before, but we may not narrow that up as much as we did last year on those two particular crops. Beans are way wide, right? I mean, bean basis is wider than normal, and looks to stay there. It is narrowing some in certain pockets for sure, but wheat at this same time period last year, we probably started narrowing already quite a little bit. We've got 40 cents to go to get to where the median basis was through the winter months on wheat, and corn probably 20. So it'll be interesting to see if that happens. But again, to your point, we have to realize that we may not see the same thing we seen last year, but there's ways of taking advantage of carries if they're out there. So if you do have an opportunity to sell wheat for Jan, Feb, March, getting into those seasonally tighter basis windows with better futures than we have on the front end, there's ways of taking advantage of that. And we need to leverage those tools. There's a multitude of them, and we've covered a lot of them numerous times on this podcast. And so the key is leverage your team. We've talked about that. You've got people in your operation that are helping you market grain or procuring your grain, whether it's a processor or an elevator or a broker. Reach out, call us, leverage those tools, and it'll set you up for success and probably better than break even. At least, there's a lot of people wondering how much they're going to lose on some of these crops. But there's been some windows where we could have taken advantage of some profits, I think.
Yeah, it's going to be interesting here as we move forward, how people handle these adversities. And I think that, like you said, leveraging the team around is going to be important. And speaking of team, we're going to go ahead and bring Jon Berglund on. Jon with Prairie Land AG. Jon, are you with us?
Yes, thanks, Jeff. Ben?
Absolutely. Thanks for jumping on this afternoon. It's exciting to have you. We're getting into the prepay period of time for fertilizer. We've run through a gamut of scenarios where, people pointing fingers at fertilizer companies for jacking up the prices. And the reality is that that's nothing new. Inflation is real. It's here. It's impacting the agricultural sector, possibly more than others. But there's ways to take advantage of these market conditions. There's information that people need in order to be successful, and that's why we have you on here. So we're excited to hear from you. If you wouldn't mind, Jon, give us a quick background. Tell us a bit more about your company, your experience.
Well, I grew up farming and ranching, and from there did a little stint as a farm manager, and then had a retail career for a while where I was an agronomist, then a location manager, bounced around there a little bit, and then did wholesale for probably 15 years or so, wholesale fertilizer trade, and then landed here with Prairie Land AG. At Prairie Land AG, it's a company that was started a little over 30 years ago,
Okay.
based around supporting independent co-ops and privately owned retailers and helping them be successful and sustainable in a space where there's a lot of large national companies, helping them compete on a daily basis.
The way I understand it, you're kind of a co-op of co-ops. Is that a good way to describe it?
Yeah, I'd say that. We're mostly based around crop procurement, but we also help out with crop protection, specialty products, other nutritionals. Since we're here for our members, we sometimes help out with things kind of outside our main scope of human resources solutions, insurance, grower finance, and alternative risk management strategies.
Well, I'm really excited to have Jon on here. We've got a history that goes way back, even in some areas that we won't cover on the podcast. But he and I have some common ground, and have spent some time overseas on some common ground, and so it's really fun to have you on here, Jon. And I'm excited to get into this topic today on fertilizer as it relates to trade tariffs and some of the other things going on in the economy. So really appreciate you taking time to do this today.
Thank you, Ben.
Let's jump in, Jon. Thanks again for joining us. The big question out there people want to know is
definitely at the end of the day, when you look at the grain economics versus the fertilizer economics, it doesn't make sense from a demand standpoint. And sometimes we get kind of focused on the demand side because that's where most of us are at. But this is a very, very supply driven market right now, and supplies are very tight. There's a lot of things going on in the world today. Whether it be domestic politics, world politics, war, tariffs, there's a lot going on out there.
Yeah, it's a crazy world, no doubt. And what's your sense from the farmer side? Is there a ceiling in terms of how much they plan to purchase in terms of fertilizer and nitrogen in order to support these crops?
Boy, I don't know. Ben, would you want to speak to that one? I'm a little bit more removed from the grower, where I deal mostly with dealers.
Yes. So, in general, the price of fertilizer does kind of cap out at some point, and the farmer just kind of locks up. You know, everybody's gonna approach that a little bit different based on how the economies of their farm are, what crops they're raising. But traditionally, when phosphorus gets real high, that's one that they tend to cut back at times. But it's also a hard one to cut back because it can really cripple you for a while. So it's another interesting discussion that is hard to pin down. We think every year that the prices are high enough to where farmers are going to back off their nitrogen, and that's usually the first one that they'll back away from. But this last year, phosphorus was pretty high, and we thought we were going to really struggle to sell the tonnage that we usually sell here at the co-op. But what we saw is producers stood in there and kind of gambled a little bit that the production was going to take care of the price a little bit and produce their way through it. But there is a point in which they do, and some did cut back, and we have seen it. But I think that's a harder thing for them to do than what the industry even realizes at this stage. I mean, because the farmers they're trying to do their absolute best to raise the crop that they need to raise to make the farm profitable, and they know if they don't put the fertilizer out there, they shoot themselves right in the foot out the gate. And not, some might skimp on going in right away with it and plan to come back over the top. That's pretty common. But even then, if they get the rain, they're going to do it.
Want more agricultural market expertise? Listen to full episodes of the Hedged Edge podcast wherever you get your podcasts, or visit rcmagservices.com. Get the complete market analysis and strategies you need to succeed.
So, Jon, let's pull back a bit, 30,000-foot view. You mentioned supply issues being the number one driver of price against the fertilizer. Can you just give us a sense, where is all the fertilizer coming in from? There's been some discussion that fertilizer has been left off the sanctions list from Russia, that in fact the U.S. does not sanction fertilizer and purchases a large amount still from Russia, despite the sanctions that we have against them and the pressure we're putting against other world economies to not utilize or buy their products. Can you just speak to the global supply of where we're getting our fertilizer?
Yeah. Global supply on all products has been fairly tight here, with one exception. But even looking here domestically, and even further than domestically, North America, um, most, not all, of the Canadian manufacturers of urea had turnarounds this past year, either summer or fall. Here at the end of October, I think most of those will be back up and running again. Locally here in North Dakota, the one fertilizer manufacturer we have here um, also had a turnaround, but across the U.S., there was a lot of plants on turnaround. You add that to kind of what we've seen out of India and China. India's always been a big buyer of urea on the world market. In previous years, they've been declining as they build more domestic production. This past year, we've seen them back to buy more. Speculated that it's possible they're idling some of their older production. China, they're usually on a major exporter of urea. They're usually into the tune of 5 to 5.5 million metric tons of exports a year. This past year, suddenly, without warning, in 2024, they cut back to under 300,000 tons. So that was millions of tons of urea just off the table worldwide. And then you
That
start.
wasn't just to the U.S. That was a global.
That was a
effect?
global event for sure. And then you look politics. This past year we started playing around with tariffs, and there was a lot of uncertainty as to what those were. If you put yourself in the shoes of a trader that's buying urea on the world market, importing it to the U.S., they're really not going to want to deal in an uncertain environment. It'd be kind of like sitting at a high stakes poker game and having somebody change the rules after your money's already on the table. There's not a lot of people that would be excited to sign up for that. And then on top of that, we've had countervailing duties that are based court judgments on trade practices that levy basically fines against certain countries that have different trade practices than us. Those were put on by the U.S. Justice Department. And then flip side of that, there's wars all over the world right now. You look at Russia and Ukraine. Russia and Ukraine are both major nitrogen producing countries. And then we got Israel and Hamas. There's some hope that that's starting to straighten itself out, but that has multiple repercussions, both through the fact that Israel is an exporter of potash, but also Israel's war has been bigger than just the war with Hamas. They've also somewhat been at war with Iran's proxies. If you look at the Houthi rebels, the main thing that they like to go out and commit acts of terror that shut down the Strait of Hormuz, which disrupts a lot of fertilizer movement.
Sounds to me, John, you need to get a degree in international politics to have your job.
At the end of the day, when it's just simple supply and demand, it's pretty easy. But when you add the human factor and foreign entities involved, you kind of need a flow chart any given day right now to figure out what's going to land where.
Yeah, that makes sense. And then do you see the shift happening where there's going to be more production in North America? I know Canada is a large supplier, that, we're not going to have to rely as heavily on some of these foreign nations, or maybe are there other resource locations like Africa or other places where we can go to source our potash and urea?
So we actually have added a lot of U.S. production. There's been a lot of production added, especially as fracking came along. It freed up a whole lot of natural gas, which is critical for making urea. Um, so both Canada's had a lot of brownfield projects where they've taken old production and added on to it. Here domestically, we've also done some of those add-ons, but we've also had a few greenfield add-ons as well, to where we have added quite a bit of domestic production. Um, we probably don't want to be at the place where the market's high enough to demand more build out here in the US. Right now, the current break even for an investment to really be worth it on nitrogen, I might be off a little bit on these figures, but I'd say $550 to $600 a ton would probably drive um, more urea build outs. It's not a short term thing to go into to add more production.
How about storage? We've talked about storage with grain. Is storage with these fertilizer products also expanding storage so that we have a larger stocks?
Um, Storage is expensive. So our current supply chain, a lot of the storage ends up being at a local level. Um, you know, Scranton's a good example of that. Not too long ago, Ben and the crew did take on building another barn. I know Phil helped them out a lot with that in the building, but a lot of that's going to be more local than it is going to be large scale wholesale and manufacturing.
You touched on the trade flow issues and some of the supply concerns. Going back to the Russia conversation, shed a little light, but I just really want to hit home that we are still buying product out of Russia,
We are
and
absolutely.
that product, as far as I know, Canada is not buying directly from Russia, but that product could potentially migrate through the U.S.
I'm not sure about the migration through the US. I do know that Canada is not directly buying Russian and is a little bit adverse to buying Russian product. There are some points at which product gets commingled. Um, but the US, it's kind of one of those things that we want to keep under our hats a little bit. We haven't talked about a lot, but right now, Russia's pretty much the only source that I'm aware of that isn't tariffed currently coming into the US for urea and UAN. So a lot of our nitrogen today is coming in from Russia.
Yeah, I'm looking it up
Seems wild.
here using a quick chat GPT search. It does source a reliable Illinois farm document stating from February that the about 15% of the potash is sourced from Belarus and Russia.
Yeah,
Phosphorus,
they'd be a large manufacturer there.
it also goes on to say that there's quite a bit of additional phosphorus coming in, roughly in 24, could have been as 13 to 14%. And so that is significant.
So there are sanctions against the phosphate coming in from Russia, I believe. And due to our proximity to Canada and them being the largest manufacturer of potash, most of our potash is going to come from there. But the market's the market. No one's bigger than the market. So um, when we see other people not buying certain potash from certain places, it does influence things as we shuffle the deck on trade flows.
If you're enjoying today's show, check us out on Facebook. Just search RCM Ag Services for market updates and tips. Find us on Facebook today.
Shifting gears a little bit, but keeping with the international theme, I had an exciting meeting down in Miami a couple of weeks ago. Met with a large company, Brazilian production influence and global export purchasing programs out of Brazil. And the feedback I got was immediate that Brazil is alive and real. Everything down there is massive. What is your sense in terms of how the technology and the resources that we've put together out of the US have found their way offshore down into Brazil to effectively support them to be our biggest competitor?
Would you be talking on the fertilizer side there?
Of course, it applies to all elements of the agricultural chain, seed, machinery, but specifically to fertilizer, yes.
I would say North America and South America do compete with each other for vessels, barges, so on and so forth. So yes, we are somewhat competing with South America at times on fertilizer, but the infrastructure within the US is far better. We're a better place to clear product quickly. New Orleans, Louisiana, or NOLA is probably one of the quickest ports as far as being able to offload a vessel and move tons. The infrastructure isn't as good in South America.
I'm really glad that you mentioned that, John. To be honest with you, it's a piece I don't think many people are talking about. They talk about how Brazil and South America are our biggest competitors, but they only are talking about for the demand of the end product. But what you're talking about is the front end side of that product, which is the fertilizer. And if they're competing and growing as fast as they have been, there's no question in my mind that they're also helping be responsible for the fact that these fertilizer prices are maintaining at higher prices. If there's more global demand, the economist in me tells me that the prices continue to be higher.
Absolutely.
And especially when you tie in their relationship, Brazil particularly, to China, it really gets muddy.
Wow, we're global traders today, guys.
Part of the goal with what we're doing here is getting people like John on this and talking about real concerns or real factors that affect the price of fertilizer, so that they're not just hearing it from their agronomist, they're hearing it from somebody that sees it from a different vantage point, um, more globally, you know, maybe more macro, but it's they're when they speak and we take that information and pass it on to the growers, sometimes it maybe isn't as well received as, for him to speak on this podcast and tell our growers, these are real concerns and we can't control any of this locally, and we have no control over the flow until it gets into the US in terms of tangible product to Southwest North Dakota or Ohio or wherever you're at. And so good insights already, on what's going on out there. And I think, this conversation could go on a lot longer in terms of, even some of the more regional issues and in particularly the North Dakota, because we're so far from NOLA, we're probably one of the furthest points, obviously, to where that product lands. But we do have local product being manufactured uh, regionally too. So there's a lot of factors to consider on why prices are doing what they're doing. And I just would ask you, John, is there anything else that we maybe didn't cover that's more regional that maybe helps shed some light on what's causing urea not to come down relative to corn, because that's what the biggest thing every farmer's looking at is corn has dropped significantly. We talked about it on the last episode, I believe, of Jeff, that when you factor in inflation, inputs are at the high end of the spectrum, and the price of production for the producer, what they're getting paid, is at the low end of the spectrum. So I just thought maybe Jon should maybe share some final insights on that piece with our listeners.
There are definitely some regional issues as well. I mean, for example, a urea plant has to go down every 2 years on turnaround. And I wouldn't even say it's regional. I'd say it's a North American issue. There's only so many people that can come in and do the turnarounds. And the reason for the need for the turnaround is when you have that much heat and expand and contract within a fertilizer manufacturing plant, you have certain pipes that they measure how much they stretch in feet, not millimeters, centimeters, or inches. So you can imagine with that much expand and contract, you absolutely have to do plant turnarounds. End of the day, when we had COVID hit, a lot of the people that can come in and do those turnarounds in plants were locked out of those plants. It was only the local employees that were allowed in. So we've kind of bunched all of our turnarounds in North America into the same time period now since then. Bright side of that, looking forward, is it looks like by November we'll have a lot of the domestic production up and running. Imports are starting to improve as we find a little bit more stability with the tariff issues. Flip side of that is if we see a lot of uncertainty with tariff issues come back, we could see that instability again. So there's a little bit of a ray of hope there. The other thing that I see as a ray of hope is potash has made the critical minerals list. That gets it around a lot of tariffs and, paves the way for other nutrients. We're already starting to work on phosphates with that. The other thing I see is, I've always heard the saying, the cure for high prices is high prices. You look at this grain versus fertilizer thing, it's out of whack. It never stays that way for too long. I don't know anything is going to happen here, but just speculating, throwing, a couple ideas out there. When you look at crop prices low and you look at fertilizer prices high and you look at where cattle prices are at right now, we've been on a long trend of taking pasture out of pasture and turning it into crop ground. Does that trend reverse? Do we start seeding more pasture with the high price of cattle? I don't know. Or do we have, maybe more of the crops that are grown for feed versus world grain? I don't know. But those are some things that I could possibly see happening that would, help correct the relationship that we have right now between low grain and high fertilizer prices.
Well, Jon, from your mouth to God's ears, everybody would like to see some lower prices, that's for sure, on the fertilizer front. But that's going to be for the market to decide. And I think that, as we wrap up here today, the important thing is to continue to work with your seed and chemical companies, to work with your local co-ops, to think about what's coming, what's going to be the next, what the next crop is going to be, what it's going to cost you to manage that crop, what it's going to cost you to handle the inputs, and how you can take advantage of forward pricing through prepay, utilizing the co-ops and their resources. And we thank you for coming on here today to discuss all of that. And we also thank our listeners. We thank everybody who's given us great feedback and engaged with us personally in person or over the phone or with text since we came on the air 5-6 weeks ago. those of you who have connected with us on Facebook and Twitter, you can find us, RCM Ag Services, on both Facebook and Twitter. You can also call us. We've got an 800 number available to hear what's going on with you, how your harvest is coming along, what prices are looking like on your end, how basis looks in your area. You can call us at 888-875-2110, 888-875-2110, or just stop in, talk to Ben over there at Scranton at the Equity, and we'll see you guys on the next time.
Thanks, Jeff.
Thanks, Jeff.